Welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. Today we'll talk about Kenya SGR extension and the 15-year bond backed by the Railway Development Fund levy. We'll do a critical project review of this. We'll take a hard project management view of Kenya's latest finance idea for standard gauge railway SGR, a 15-year Kenya shillings 390 billion bond backed by the Railway Development Fund RDLF, where we say that the headline is simple, where the plan is to raise cash now by pledging future levy receipts. But the story beneath is complicated, political, and full of risk. This dispatch walks through the plan, the context, the math, the comparable Talanta Stadium bond, and the hard questions that remain partly unanswered in public. Why has it taken so long for Kenya to pick a financing model? We have heard of various options being thrown about. Kenya SGR extension, which is Naivasha, Kisumu to Malaba, has been on the drawing board for years. The first SGR leg was largely financed with Chinese loans. Later phases have stalled because lenders demanded firmer commercial viability, and Kenya public debt levels left little appetite for more sovereign borrowing. That deadlock pushed Treasury to explore alternatives that raise domestic capital without immediate fresh external loans. The result, the government is reportedly eyeing a 15-year 390 billion Kenya shillings bond to fill that gap. This delay reflects three hard constraints. 1. Capital intensity of the project. 2. Uncertainty revenue from freight passenger traffic. And 3. Fiscal space limits and high debt service. Pushback from potential external funders have made the government seek instruments that monetize predictable domestic revenues. Hence, this idea of Railway Development Levy being securitized. Let's now look at the price tag and the Matui funding reality. Estimates for Naivasha Malaba extension, they are varying. Figures reported include roughly 549 billion Kenya shillings up to 648 billion Kenya shillings. That depends on the scope and port inland depot works. In other words, even the 390 billion bond will likely cover only part of the bill. The remainder will need to be filled by a combination of government appropriation, PPP equity, concessional loans, or further securitization. That multi-channel funding model creates sequencing risk. If one tranche fails, the whole cash flow plan can be thrown off. Now let's talk about the levy. What is it and how was it formed? The Railway Development Levy is a statutory charge on imports. It's between 1.5 and 2%. And it was created to provide a dedicated revenue source for railway projects. Collection averaged with recent KRA figures showing that Railway Development Levy receipts were around 39 billion Kenya shillings, and these annually it reaches between 36 to 50 billion Kenya shillings. And the viability matters. Securitization converts these future volatile receipts into fixed obligations today. That's the trick here. What is securitization? Let's look also at the benefits and also practical mechanics that surround this securitization debate. Securitization here means pledging future levy receipts to a special purpose vehicle that issues bonds. Investors receive coupon and principal from levy cash flows. The government receives cash upfront to build the railway. Advantages are clear for project managers. There is fast mobilization of contractors, reduced start delays, and dedicated repayment source that can be marketed to pensioner funds and insurers. But the bond is still a loan in economic substance, simply repackaged. The Capital Markets Authority CMA process for listing or approving asset-backed bonds require documentation such as information memorandum, legal opinion, SPV structure, declaration from originator, and more. Proper structuring must follow CMA checklist and disclosure standards to protect investors and the public. Let's have a comparator, a live comparator, which is now in this case Talanta Stadium bond. Kenya recently approved and listed Talanta Lindsay Finco infrastructure backed bond, which was which amounted to 44.79 billion, and it was 55 years. That instrument is instructive because it uses an amortized repayment profile, not a single bullet. Total interest paid over 15 years is large but calculable. Analysis put its interest as roughly 69.2 billion Kenya shillings, with total repayment around 114 billion. Talanta bonds shows you can place big domestic infrastructure bonds and be successful, but it also shows the long-run cost of such funding. Let's scale that Talanta outcome as an illustrative exercise and not a prediction. Proportionally, applying Talanta interest rates to this which is being proposed, the 390 billion Kenya shillings issuance, suggests interest payments in the order of 600 billion Kenya shillings over 15 years, and total repayment approach to Kenya shillings 993 billion. That's a blunt, illustrative scaling. In actual terms, the coupon, amortization, credit enhancement, they may change the total, but the takeaway is stuck. Front-loaded capital today becomes a very large stream of repayment over time. What are the benefits for the project? The speed, investor base, and also signal effect. If properly structured, levy-backed bonds could A, unlock capital fast, B, deepen domestic capital markets, and also send signal of commitment that help attract complementary financing, which is concession debt, PPP, equity, among others. For operations-minded project managers, speed reduces escalation risk and also improves contracting prices. Let's look at the risks in terms of revenue, governance, and also fiscal illusion. But the downside are material. We have revenue volatility. Levy receipts depend on inputs, economic shocks, trade policy changes, and also rate reduction can shrink the pool that services the bond repayment. Recent years have shown swings in revenue development levy or railway development levy collections. Then there is hidden or contingent liability. Securitization may be structured as off-balance sheet in headline fiscal tables, while still creating binding future obligations. Parliamentary debates at the Audit Office concerns in Kenya have highlighted the danger of such hidden debt. Without full disclosure, risk allocation is opaque. Then there is operational mismatch. Construction timelines, ramp up freight volumes, and also revenue realization rarely align perfectly. If the railway underperforms, taxpayer bailout become likely. Then there is legal or governance gap. Parliament and watchdogs have raised questions about whether pledging statutory levies require explicit legislative process or approvals, a constitutional and governance question that matters for investors' confidence. Then, what may be in the public domain and what remains unclear? Official statements and media reports have described the bond concept and levy backing, but critical transaction details are not yet public. The exact term sheet, coupon, amortization, schedule, and also credit enhancement, if there will be any, and also talk about which entity underwrites the bond and who bears the shortfall. Will it be Treasury, will it be SPV, or will it be creditors? Past SGR loan contracts and other infrastructure deals have contained confidentiality clauses. Parliamentary committee minutes have pressed for disclosure. That pattern suggests pieces of financing architecture may already have been negotiated but not fully disclosed, which is a governance flag. The question that we're asking ourselves here is that is securitization a fix for Kenya's rising debt? The answer is straight no. Not by itself. Securitization converts future receipts into present cash. It does not erase the obligation to pay. If used selectively, transparently, and with conservative stress test, it can be a valuable part of diversified financing strategy. If used to paper over weak project economics or borrow against uncertain future revenue repeatedly, it risks compound Kenya fiscal vulnerability. How this should be handled from a project management checklist. There should be full transparency where they publish the offering memorandum, term sheets, and also SPV documents before approval. CMA rules already support this. Conservative revenue assumptions, stress test levies receipts, and the downside scenarios in terms of slump in trade or even policy change. There should be robust governance, independent trustee ring-fencing covenants, and also parliamentary oversight should be there to avoid off-budget surprises. Then there should be contingency plans, clear waterfalls for repayment, and explicit budgetary backstop clauses only at last resort. Then value for money, ensure that the SGR extensions economics returns justify long-term commitments. Do not let financing shape the decision to build. In conclusion, we can say that securitizing the Railway Development Levy to fund the SGR extension is innovative and also offers short-term certainty for cash. But the long-term cost, governance implication, and also risk in terms of revenue are real and quantifiable. The Talanta bond shows domestic asset-backed issuance is feasible and also expensive in aggregate. Kenya's choice is not between boldness and caution. It's about how boldness is exercised. Without full public disclosure, conservative assumption, and ironclad governance, the instrument risks trading immediate progress for less visible, heavier fiscal burden down the road. This is a solvable problem, but only if the deal is structured with the discipline of a project finance, the scrutiny of public oversight, and humility to accept that future revenues are not the same as cash in the bank today. So thank you for reaching this far. If it's your first time here, please consider subscribing to this channel. Also, hit the notification bell so that whenever you upload a new video, you are notified. You can also leave your comment or thoughts about this whole saga of securitizing the Railway Development Levy to fund the SGR extension from Naivasha to Malaba. Thank you.